So today we are here to do Lease and Accounting Standards Update. So thank you everyone for joining us. As a quick introduction, my name is Schiller. I am a Technical Assurance and Quality Control Principal at Vrakas, kind of a long title there. But in terms of background, I have over 16 years of experience working on the client service side of public accounting firms, mostly middle market clients, privately held. During that 16 years, I primarily worked on the client service side where I had my own clients and was doing audits. Recently in March, I moved over to more of an internal role at Vrakas, where I am assisting the assurance group or the audit group with their risk assessment strategies and audit methodology, as well as working with teams to communicate technical guidance that's coming out and helping to implement new accounting standards. I also lead our internal and external peer review process. I did include my contact information here, so if you have any follow-up questions or need any assistance after the session, please reach out and I'd be happy to help. Quick agenda today. We are going to be spending the majority of our time talking about the new lease standard. That's because that's the most relevant standard, the one that's coming up the quickest. So we're going to spend a lot of time on that. We'll talk about the two different types of leases and how the lease terms will impact accounting under the new standard. We will talk about the disclosure requirements as well as the next steps for implementing the lease standard. And then at the end, we'll talk about two other standards pretty quickly. One is the new credit loss standard, and the second one is reference rate reform. So let's quickly get into leases. Just as some background, the first lease accounting standard was issued in November 1976 when Gerald Ford was president, and it was 77 pages long. The new lease accounting standard is over 300 pages long, if that gives you any insight as to maybe the more technical road that we're going down in terms of accounting standards. So what is the difference? Under the previous lease standard, there were two classifications of leases, and those were capital and operating. And those capital leases were recorded on the balance sheet. So let's say you were leasing copiers. You would record the copiers as a fixed asset, and you would record a liability for those lease payments. If it was an operating lease, it was not recorded on the balance sheet, and you just had footnote disclosures. So under the new lease standard, there are still two classifications of leases. They're either going to be finance, which is very similar to the old capital, or operating. But under the new standard, both types of the leases will be presented on the balance sheet. The difference being how they're presented on the income statement, and we will talk through that. So the question might be, why is lease accounting changing? Really, the previous criticism was related to those operating leases, which were not recorded on the balance sheet. They were only in the footnotes. So the goal is to really increase the transparency and comparability between financial statements of different organizations by bringing all of those leases onto the balance sheet. So what is the most significant change? We are going to recognize what's called a right of use asset and lease liability for all leases. So again, not just the capital leases, but operating leases as well. The one exception is if a lease meets the definition of a short-term lease, and we'll discuss that later in the presentation. So essentially what's going to happen is you're going to have a gross up of your balance sheet because you're going to be recording this right of use asset as well as the lease liability. So in some ways, it's maybe not a huge impact because, again, you're just grossing up. You've got an asset and a liability. What it could impact is potentially different financial ratios that a company might use for debt covenants or different reporting purposes, such as a debt to equity loan covenant, because your liabilities are increasing, but your equity is staying the same. When is the change effective? If you're a private company, it's for annual reporting periods beginning after December 15th, 2021. So essentially, if you're a calendar year-end company, that means you're going to adopt this new standard on January 1st, 2022. Now, if you only do annual reporting, you maybe won't start worrying about this until towards the end of 2022 when you have your first financial statements coming due. But if you do any type of monthly or quarterly reporting in accordance with GAAP, you would need to adopt, at the appropriate time so that those financial statements are in compliance. Okay, let's talk through the overall process. I decided to put a 5-step model here only because it's kind of consistent with the revenue recognition model that you probably adopted a year or two ago. So during this presentation, we will step through each one of these and talk through the details. So step 1 is really to determine if your contract actually contains a lease. And the definition of a lease is here, but essentially it's the right to use a piece of property for a period of time in exchange for a payment or some type of consideration. There are some things that are specifically scoped out of the definition of leases, so it does not apply to intangible assets, biological assets, inventory, or assets under construction. So it really is those PP&E fixed asset type of items that are going to fall under the lease definition. Step 2, once you know that you have a lease, is determining the lease classification, whether it's finance or operating. And there's some key ingredients here that we're going to use to determine the lease classification. We'll talk through each of these. Just kind of want to make an overall note that these terms or these key ingredients are very similar to the information that we would have used under the previous model to determine if we had a capital or operating lease. So a lot of this should be pretty familiar. Key ingredient number 1 is the commencement date. So a change here is that the commencement date is not necessarily the date that a lease starts per the contract, and it's not necessarily the date that a lessee starts making payments. It's the date that the lessor makes the asset being leased available to the lessee for its use. So a common example that we see a lot of times is if a lessee is leasing office space and the lessor makes the office space available to the lessee maybe 3 or 6 months ahead of time so that the lessee can build out some tenant improvements. In that case, the commencement date would be the date upon which the lessee gets access to the space. It's not the date upon which the lessee begins making payments or the date upon which the lease might call the start date or commencement date. And that's going to become a very critical difference and determination as we move forward and talk about some of the other components in lease determination. So key ingredient number 2 is the discount rate. And there's a couple different ways to go about this. If it's available in the lease, you would use the rate that's implicit in the lease. I would say probably 99% of the time there is no rate implicit in the lease, in which case you can move on to the next option, which is the lessee's incremental borrowing rate. This would be a rate that the lessee would be charged if they obtained a loan from a bank that's collateralized with the same type of asset, has a similar term, has approximately equal payments, etc. As a private company, you can also elect option number 3, which is to use a risk-free rate. So essentially you would make an accounting policy election and say that you're going to use a risk-free rate as opposed to your incremental borrowing rate. So in the US, that would be the rate of a 0 coupon treasury bill for a similar period of time as the lease term. And just a note that while using the risk-free rate would probably make the accounting easier in some circumstances because you don't have to go to the trouble of determining your incremental borrowing rate, it also would probably result in larger liabilities since the risk-free rates would typically be lower than your incremental borrowing rate. So you're not going to get as big of a discount when you do the net present value of all those payments. Key ingredient number 3 is the lease term. The lease term begins at the commencement date, which as we discussed earlier is not necessarily the start date per the lease agreement. And you would include any non-cancelable periods for which the lessee has the right to use the asset. You should include any rent-free periods. So as we discussed in that office lease example, if you get access to the space for 3 or 6 months to do tenant improvement build outs, you would include those months in your lease term. You would also include any periods covered by your renewal option if you are reasonably certain to exercise the option. Now, that is very subjective. There's no particular guidance in the standard that defines reasonably certain. So it's definitely going to be facts and circumstances of every company and also facts and circumstances of every lease. It kind of depends on your historical rate of exercising renewal options, as well as your future plans. For an example, let's say that you have been in the same manufacturing facility for 15 years and you've been exercising 5-year renewal options. So based on your history, it would seem that you're reasonably certain to exercise your next 5-year option. But maybe based on your business plans, you're expecting to expand your business by 50 or 100% within the next 1 to 2 years. In that case, you might decide that you're going to outgrow that space and you're going to need to move, in which case you might determine that you're not reasonably certain to exercise the option. So it's really both of a backward-looking and forward-looking analysis. And again, very subjective. Key ingredient number 4 is purchase options. So this would be, gives the lessee an option to purchase the underlying asset. If the lessee is reasonably certain to exercise the option, the lease would automatically be classified as a finance lease, similar to the old capital leases. If a lessee is not reasonably certain, you would continue going through the same lease classification determination that you would on any other lease. And lastly, key ingredient number 5 is the lease payments. So when we talk about lease payments, we would include any fixed payments that are defined within the lease, as well as any variable lease payments if those are based on an index or a rate. So as an example, sometimes we see that lease payments are increased by CPI, that would be an index, or they're increased by 3% or 5% each year, so that would be a rate. In those cases, even though those are variable payments, you would include those within your lease payments. You would exclude any variable lease payments that really are variable that you don't know. An example of that would be sometimes we see retail locations where they owe rent based on the total amount of sales that they have, percentage rent. That would not be included in this calculation because you essentially don't know what those sales are going to be, so you don't know what variable rent will be. Other payments to consider when you're looking at your total lease payments are things that you're receiving, such as lease incentives, or if you owe any security deposits, purchase options, etc. So it's really any type of payment under the lease. So once we have all 5 of the key ingredients, we can now determine our lease classification. Similar to the previous guidance on capital leases, if you meet any of the criteria, your lease will be classified as financing. If you don't meet any of the criteria, your lease would be an operating lease. So we'll go to the criteria on the next slide. These are very similar to the 4 criteria that we had under the old model to determine a capital lease. One difference is you'll notice that there's 5 criteria on this slide. So criteria number 5 is the new one. And this says that if the underlying asset's specialized nature is expected to result in it basically not having an alternative use to the lessor at the end of the lease, you would assume that it's a finance lease. The first 4 criteria are very similar to the 4 criteria that we're used to with our capital leases. Something to note though is the guidance under the new standard is a little more vague than the guidance was under the old, the guidance under the new standard is a little more vague than it was under the old standard. As an example, criteria number 3 says, when the lease term makes up a, quote, major part of the underlying asset's remaining economic life. Under the old standard, it would say if the lease term is greater than 75%. So it was a very specific line, a very specific calculation. And if you were above 75%, you triggered. And if you were below, you didn't. Like I said, this new standard is a little bit more vague. It just uses this term called major part. So it doesn't have the bright line. However, in the standard, they provided some implementation guidance. And if we look at this first check mark here, it says for purposes of determining whether the lease term makes up a major part, a reasonable approach would be to use a threshold of 75% or more. So while the 75% is not contained within the guidance itself, it is within the implementation guidance. So we can still use 75% as basically like a gauge. But I think what the standard setters were trying to say is if you're at 74.9%, you shouldn't say, oh, you have an operating lease automatically. You should be a little bit more flexible in terms of that 75%. So hopefully that makes sense. So once we know whether, excuse me, I'm gonna here, okay. Once we know whether we have a a finance lease or an operating lease, we can then determine our initial accounting. So under the new standard, on the commencement date of the lease, and again, that's not necessarily the start date per the lease agreement, the lessee is going to recognize those right-of-use assets and lease liabilities for all leases, unless you have a lease which meets the definition of a short-term lease. So a short-term lease is one in which the lease term is 12 months or less, and there is not an option to purchase the asset that the lessee is reasonably certain to exercise. So when we look at this, it says the lease term is 12 months or less. As we talked about earlier, when you're considering what the lease term is, you have to evaluate those available renewal options. So let's say you had a lease that was 12 months long and it included 5 one-year renewal options. And you think you're probably likely to exercise at least one of those one-year renewal options. Well, now you really have a 24-month lease or a 2-year lease, and you would not meet the definition of a short-term lease. So you're going to have to consider all those renewal options, even if it's a month-to-month lease. Need to consider that before you automatically assume that you have a short-term lease. Because of this definition, we think that short-term leases are actually going to be pretty rare because it's not likely that people are going to enter into a lease that they expect to only use for, let's say, 6 months or 12 months. It definitely can happen. Not saying that it's never going to happen, but it just seems like it would probably be rare given this definition of lease term and commencement date. So the initial accounting is actually the same for both finance and operating leases. What you're going to do is you're going to take all those lease payments that we talked about, those fixed payments, the variable payments, if they depend on a rate or an index, security deposits, etc. So any payments that have not been made over the entire lease term, you're going to use your discount rate and calculate the net present value of those lease payments on the commencement date. That's going to be your liability. On the asset side, you're going to start with the liability amount and add any lease payments that were already made. You're also going to add any initial direct costs that were incurred by the lessee and subtract any lease incentives. I want to talk for a minute about this initial direct cost because the definition under the new standard is a little bit different than what it was under the old standard. So an initial direct costs are incremental costs to obtain a lease that the lessee would not have incurred if they had not entered into the lease. So it's much more narrow than it was under the previous guidance. So for example, if you spend money going to look at different office spaces, or you spend money working with different lawyers or brokers to show you those different spaces, that would not meet the definition of an initial direct cost because you incurred those costs whether or not you end up entering into a lease for that space. What would meet the definition is if there's a commission due to an employee or a broker once you have actually signed that lease. So initial direct costs will most likely be less under the new standard than those direct costs were under the previous standard. So that's the initial accounting. Again, it's the same for both types of leases. Step 4 in our process here would be determine the subsequent accounting, so the day 2 accounting or the month-end accounting. So let's talk about the lease liability first. Again, this is nice because it's the same for both finance and operating leases. Essentially, what you're going to do is reduce your liability by the amount of the payment that you made and increase the liability slightly for the accretion of that discount. And then as kind of a double check, you could always do the calculation where at the end of each period, the balance of the lease liability should be equal to the present value of your remaining lease payments. Subsequent accounting, let's talk about the costs associated with the different types of leases. So for a finance lease, again, these are very similar to our previous capital leases. What you're going to do is record amortization of your right of use asset. And this should be done on a straight line basis, very similar to under the previous model when we booked the actual asset, and we would record depreciation expense on those assets, which we typically did on a straight line basis. You're also going to have interest cost equal to the accretion of that net present value of the lease liability. If you have any variable lease payments that you didn't include in your lease payments because they were variable and they were not based on an index or a rate, you're going to be recognizing those in the income statement as well, separately from your amortization and the interest cost. On the asset side of things, you're going to record the amortization on the right of use asset. And again, that's going to be on a straight line basis. Something to note is the balance of your liability may differ from the balance of your right of use asset because the asset includes any of those initial direct costs and payments that were already made. Again, those initial direct costs are probably going to be fairly rare, but the other big difference is that your liability is being amortized using the effective interest method, while your right of use asset is being amortized straight line. So those two numbers will be off a little bit. They'll be pretty similar, but they will be different. I'm just going to take a break here and get a drink of water. I also might just take a break here and let's see, end my slideshow really quickly just to see if we have any questions in the chat. I can't see those. Doesn't look like it. Okay, I'm going to start my slideshow again on the current slide. There we go. Okay, so we just talked about that the asset and the liability may be a little different because they're being basically recorded under different methods. In contrast to the finance lease, the costs associated with an operating lease are going to be a single lease cost, just basically lease expense or rent expense, whatever you decide to call that. And that's going to be based on amortizing the remaining lease costs over the remaining term on a straight line basis. So this is very similar to our old concept of deferred rent, where we took all those lease payments, added them all up, determined our straight line amount, and recorded that as lease expense each month. Again, if you have variable lease payments that you didn't include in your lease payments because they're not based on a rate or an index, you're going to also record those, on a monthly or quarterly basis as those are incurred. In terms of the right of use asset under an operating lease, it's very interesting because the standard itself does not use this term, but all of the implementation guides use this term, that it's basically a plug method. So the amount that you're going to amortize your right of use asset each period is going to be the difference between that single lease cost or that straight line amount that you calculate and the amount that you're recording as the accretion of the lease liability. So that's subsequent accounting. Next, step 5 of the model, we're going to talk about presenting and disclosing the leases. So just kind of wanted to summarize here that in terms of the income statement side of things, for a finance lease, you're going to have amortization and interest. And for an operating lease, you're just going to have lease cost or lease expense within your continuing operations. In terms of the balance sheet, if you felt like you really wanted to add some financial statement line items to your financial statements, this is the standard for you, because you're going to add up to, I would say, probably 6 new financial statement line items. That is because the standard requires you to present the assets and liabilities separately for operating leases and financing leases. If you don't want to present them as a separate line, like let's say you have operating leases, but your operating lease right of use asset is not a huge number and you don't think it warrants its own financial statement line item, you can include it with another line item such as other assets. But if you do that, you have to disclose in the financials which line item those are included in. And under no circumstances should the right of use assets or the lease liabilities for financing and operating leases be included in the same balance sheet line items. So essentially, if you put your operating lease right of use assets in other assets, you shouldn't put your financing lease right of use assets in other assets as well. Those should be separated. On the liability side, the portion of the liability that you expect to pay within the next 12 months should be classified as current, very similar to how we present any type of debt payment. And so you could have current liabilities for operating leases as well as current liabilities for financing leases. There is no shortage of disclosure requirements under this standard. Really no surprise there that FASB keeps going more and more towards more robust disclosures. So I've just kind of listed the highlights here. This first page is probably very similar to what we're already disclosing, whether you have a financing lease or operating lease. Here's some more. One thing I wanted to note here is that when you have those short-term lease, if you have a short-term lease that you end up not capitalizing, you're going to just expense those lease payments as you make them, which is all fine and good, but you do then need to disclose your short-term lease costs. You also need to disclose your variable lease costs, and this would be those variable payments that are not based on a rate or an index. At the bottom here are 2 new type of disclosures, which is your weighted average remaining lease term and your weighted average discount rate that you've been using. But there is still more. The maturity analysis of your liabilities, which is very similar to what we're used to, leases with related parties, etc. And then there's some practical expedients here that we will talk about on the next couple slides as we talk about transitioning to the new standard. So just kind of want to pause there. That would be the 5-step model for how you're going to determine you have a lease, determine what type of lease you have, account for that lease, present the lease, and disclose the lease. So now we're going to move on to transition methods. How are you actually going to implement this standard? So there's 2 options available. Method A is that you would adopt the new standard, which is Accounting Standard Codification 842, and you would apply it retrospectively to each reporting period that you're presenting in your financial statements. Method B is that you would adopt the standard and apply it retrospectively to the beginning of the period of adoption through a cumulative effect adjustment. So just as a quick kind of visual here, let's say at the end of 2022, you're presenting comparative statements with a 2022 column and a 2021 column. You would, actually those should be the different years, I'm sorry, it should be 2021 and 2020. So under method A, both of those years would be under 842. So you would adopt it at the beginning of the year that you're presenting. Under method B, 2021 would be under ASC 842 or the new standard, but your prior year, the year in which you did not adopt the standard, would be under the old standard or ASC 840. So you're really just showing it as of the beginning of the period that you actually adopted you're not going back and restating both of those comparative periods. Whichever method you decide to use, method A or method B, you can also elect a practical expedient. So this is cleverly named a package of transition practical expedients. If you use this package or adopt this package of practical expedients, you have to adopt every single one. You can't pick and choose. But essentially, we think that most clients will choose to utilize these practical expedients because it should ease your adoption of the standard a little bit. So what it allows you to do is that you don't have to go back and assess your current leases under the new standard to determine certain things, such as, does your contract contain a lease? So if you had contracts previously and you didn't think that they contained a lease and you didn't account for them as a lease, that's fine. You can leave those as they are. You don't have to go back and look at them in comparison to the new definition and see if they are a lease or not. The other thing that you don't have to reassess is your lease classification. So if under the old standard, you determine that a lease was a capital lease, and you've been accounting for it as a capital lease, you will continue to account for it as a financing lease under the new standard. One thing I do want to point out there is the new guidance is not expected to significantly change lease determination anyway. So it's not that there was an expectation that if you went back and reassessed your leases, you would come to different conclusions. It should be very similar either way, but it is nice that you don't have to go back and redocument or reanalyze any of those existing leases. And the third is that you don't have to go back and look at those initial direct costs and see if they meet the initial direct cost definition under the new standard. If you had capitalized direct costs under the previous standard, you can just leave those and continue to account for them as you were. So again, if you elect one of these three options, you basically have to adopt them all. And we do expect that most clients would probably do so because it should ease the burden of transition and adoption of the standard. A couple other miscellaneous things to point out is related party leases. So the guidance in the new standard, ASC 842, says that basically you should look at related party leases the same way you would any other lease, so any other third-party lease. Under the old standard, there was some guidance that specifically said that for related party leases, you should modify your conclusions or your accounting for those leases to recognize the economic substance rather than the legal form. The new standard very specifically does not contain that guidance. It actually only contains about one small paragraph about related party leases. And I think really what they were trying to get across there is there's really not separate guidance on related party leases. They should be accounted for and looked at as any other lease would be. So that's a big difference from the old standard. Other thing I wanted to point out is that there is no scope exception for small ticket items or immaterial items. Interestingly enough, the international standard does have an exemption for assets less than $5,000. So the FASB standard does not have that exemption. However, we would always say that materiality should be considered, and something that I've heard on a lot of webcasts is, considering your capitalization threshold when you're looking at whether or not you need to capitalize leases for smaller items. Vrakas has paired with a software company called Lease Query that we can use this accounting software to input all the different lease terms, and it will kick out a lease determination. It will kick out the amortization schedules. It will kick out the journal entries that are needed. And I think most importantly is all the footnote information needed under the new standard. So we do think that, if you have a lease portfolio of maybe more than 5 or 10, whatever that threshold is for you, where it kind of seems like it's cumbersome, we do think that this partnering with Lease Query and having this software option available will be helpful so that clients don't have to take all of that accounting on themselves, and clients don't have to create a bunch of spreadsheets and maintain spreadsheets, especially if you end up renewing a lease or something like that. It's very easy in the software for us to just input those renewal terms, and it will kick out the new amortization schedules and journal entries for you. Quickly, just to talk about next steps as you get ready to implement this standard, I think the most important thing is to get an inventory of all of your leases. So gather all your contracts, all of your paperwork. There's obviously contracts that are called leases that you've probably already been accounting for as leases, and you know about those. But consider, other contracts that you may have that might contain embedded leases. And an example that I've seen is cloud hosting arrangements. So in some cases, under those cloud hosting arrangements, you're actually leasing a server from the company as opposed to just paying for monthly hosting services. And another way for you to kind of get that completeness of your lease inventory is just to review your general ledger accounts, whether it's lease expense or rent expense or something like that, making sure that anything that's hitting those accounts, you feel comfortable that you have the related paperwork and that you're accounting for those correctly. And then once you have that complete lease inventory, doing the lease abstraction. So pulling out those key terms and conditions that we talked about that are necessary for you to determine the correct lease classification. Okay, so I'm gonna just take a break here. So we've reached the end of our section on leases specifically. Are there any questions on leases that anyone wants to ask or submit via the chat or anything like that? Okay, Nancy has a question. What is the offset if the asset and liability do not match? So each one, the asset and liability are they're amortized under different methods. So the liability side of things is going to use the effective interest method essentially. So that's going to be kind of like its own journal entry there. And then when you amortize the right of use asset, that's going to be either on a straight line basis, if it's a finance lease, or if it's an operating lease, it's kind of that plug method that we talked about briefly. So they don't necessarily have to agree, because I would say you're kind of making separate journal entries for each one. If that makes sense. Okay, I'm going to go back to the slideshow here. So now that we're done with leases, we're going to move into two other topics that are kind of up and coming. And the one that's going to be implemented after leases is topic 326, called credit losses. So this standard has been talked about for quite a while. The FASB first issued guidance on this in 2016. And basically this new standard is going to change how a company records or recognizes credit losses. It's commonly referred to as CECL, or current expected credit loss. This whole standard, I should even back up a little bit, because the FASB issued the new standard in 2016, but they've actually been discussing it since probably 2008 or 2009, because really the criticism over the current model came up during the credit crisis back in 2008, 2009. That our current model, which was an incurred loss model, delayed the recognition of certain losses that companies knew were coming, because the existing standard has you recognize those losses once you know that those are happening, as opposed to this new standard, which is more of a forward-looking standard. And I think initially when this standard was issued, a lot of people thought that it only applied to financial institutions or banks, because it was only going to apply to loans. And it does apply to loans, but it also applies to trade receivables. So really any company that has accounts receivable or any other assets that are recorded at amortized cost, this credit loss standard is going to apply to you. So as I talked about, it eliminates our prior accounting model that had you record a loan loss or a bad debt expense when it was probable that a loss had been incurred. So something had to have happened that made you think a loss was going to happen. The CECL model is a forward-looking model, and it requires the company to develop an estimate of the credit losses that they expect to incur over the contractual term of the receivable. So one of the reasons I think people thought this was only applicable to banks is because banks have they have a longer holding period of their loans, right? So those are the receivables that are on their books for 10, 20, 30 years. So when you think about this model and you think about the fact that you have to record losses over the contractual term, that's going to be higher losses probably because you're holding the asset for so long. Versus if you're a manufacturing company and maybe your receivables turn every 30, 60, or 90 days, the impact of this standard and the impact of recording losses over your quote contractual term is probably a little bit less since you're not holding the asset as long. But essentially what you have to do, whether you have loans or just accounts receivable, is record a reserve for the amount that you expect to not collect over the life of the asset. So you might be thinking, well, how am I going to do that? The standard says that these expected credit losses should be based on historical experience, as well as current conditions, as well as forward-looking information, such as the probability of a market downturn or economic issues. So you record your initial loss estimate when you record the receivable, and then you update it each reporting period. And any change in that credit loss is just going to flow through your income statement for that period. The standard says that you can determine, your credit losses based on a variety of methods, including, some type of method that uses an aging schedule, which is probably what a lot of people use currently. There are expanded disclosures, of course, because the FASB loves to have more and more disclosures, and it is adopted at the beginning of the reporting period in which the guidance is effective. For non-public companies, it's effective for fiscal years beginning after December 15th, 2022. So for a calendar year-end company, this would essentially mean you're going to adopt the standard January 1st, 2023. There are no special provisions for private companies. And what I mean by that is occasionally the FASB will issue, private company guidance that intends to make accounting guidance a little bit easier for private companies. They have not done that yet related to credit losses. So as it stands right now, a private company would be adopting the standard just as a public company would. The next topic that I want to talk about is topic 848, also known as reference rate reform. So this has been kind of a buzzword or a buzz term for the last year or two, but essentially what's happening is the London Interbank Offered Rate, or LIBOR, is going to be phased out. And I know that we personally have a lot of clients whose debt agreements have some sort of reference to LIBOR. What would typically happen is that if you had to modify your existing debt because you're changing the reference rate within the debt, that would require contract modification accounting. And that can be very complex and can also result in gains and losses. So essentially what this standard does is provides relief from the existing accounting rules on contract modifications, so that if the only reason you're renewing or restructuring your debt agreement is because you need to change the reference rate within your agreement, you don't have to go through sort of the hassle of doing accounting for that as a contract modification. So it is intended to make accounting easier. Again, there are no special provisions at this time for private companies. This relief under this topic currently is only effective through December 31st, 2022, because LIBOR was expected to be phased out by that time. However, in March of this past year, in 2021, LIBOR's regulator did announce that they are going to continue publishing LIBOR until June 30th, 2023. So we do expect that the FASB will extend this standard to go beyond June 30th, 2023, since they're going to continue publishing LIBOR through that date. However, they have not done that yet. So more to come on that. I'm sure that you'll be hearing about it. And again, I'm sure that the FASB will renew this standard or extend it so that it's applicable to everyone.